Hello everyone, welcome back to my channel. I am Deeksha and this is episode 2 of my investment banking series on the book Investment Banking by Joshua Rosenbaum and Joshua Paul. So in the last video, I gave you a high level overview of the book, right? And in today's video, we are going to start with part 1, which is valuation. And I will cover chapter 1, which is comparable company analysis, also known as CCA, and trading comps or trading comparables. So I'll explain everything in very simple language and we'll also run a clear example alongside so everything can actually make sense for you. All right? Okay, so let's start. Okay, before we get into technicals and before we get technical, let me tell you something very important. So comparable company analysis is usually the first valuation method investment bankers use. Why, you may ask? Because it is quick, it is practical, and it is closely tied to real market prices. So if you understand CCA well, you're already thinking like a banker. So that's why this is very important for us. Now, you may ask, what is comparable company analysis? Like, what exactly is CCA? So in simple terms, CCA means valuing a company by comparing it with similar publicly listed companies. Okay, what did I say? That you are valuing a company, you have a company, let's say XYZ, okay? So you are going to value this company by comparing it with similar publicly listed companies. All right. Yep. So the logic is very straightforward. If similar companies are trading at certain prices in the stock market, then our company should also be valued in a similar range, right? It makes sense. So think of it like this. So if you want to estimate the price of a flat, you don't want to start with complicated formulas. What you will first do? So you first will look at similar flats nearby this property, all the flats that are selling for, like what nearby flats are being sold for. So CCA works exact same way, but not for flat, for companies. Okay. So to make this easy, let's take a simple example and we will use this example throughout the video. Imagine we want to value a company called ABC Technologies. So ABC Technologies is a mid-sized IT services firm operating in India. Okay, so similar in business model to large IT firms. Now, to value ABC Technologies, we will compare it with listed peers like what would be the listed peers for ABC Technologies? There would be TCS, Infosys and Wipro, right? So these companies will form part of our peer group. These companies, TCS, Infosys and Wipro, will form part of our peer group. Okay, so now let's understand stepwise how do you do comparable company analysis. So what are the steps? So the first step would be selecting the right comparable companies. So this is very important. Why? Because bad comparables lead to bad valuation. So it would be like garbage in, garbage out. If you have bad comparables, then how are you going to get good valuation for your target company? So that's why it's very important to select the right comparable companies. And for this, we usually look for companies that are similar in industry, business model, size of the company, the growth profile, and the geography that they operate in. So in our example, ABC Technologies is an IT services company in India. So companies like TCS, Infosys, and Wipro are reasonable comparables. Although I want to add this, that these companies are not identical. But what we have here is they are close enough to give us a market benchmark. So we'll take these companies. Okay, now step 2 is collecting financial data. So once we have selected our peer group, the next step is to collect financial data. From each comparable company, we typically look at revenue, EBITDA, net income, market cap, debt of these companies, and their enterprise values. So now let's assume some simplified numbers just to understand the concept. So let's say TCS has an EBITDA of 50,000, Infosys has an EBITDA of 35,000 and Wipro has an EBITDA of 20,000 crores. All these numbers are in crores. Now we also know the enterprise value because we know the enterprise value from the stock market. So these are the enterprise values. So now let's talk about step 3, calculate valuation multiples. Now using these two things, we can easily calculate valuation multiples. So in this example, this is a very simple example. That's why we have kept it 12x, right? The multiple is same for every company, which is 12 times. So basically the enterprise value is 12 times the EBITDA. So now comes step 3, which is calculating valuation multiples. This is, I would say, the most important part. One of the most commonly used multiples in CCA is EV by EBITDA, right? Why? Because this tells us how much the market is willing to pay for 1 rupee of operating profit. 1 rupee of operating profit. How much the market is willing to pay. So we will calculate EV to EBITDA multiple for each company. And in this example, this is a very simple example, we have taken it 12x. Like if you do the calculation, you will get 12x for each company. So now all 3 companies are trading at 12 times their EBITDA. This means that the market is valuing IT services company at roughly 12 times their EBITDA. Right. Now let's talk about step 4. Step 4 is applying multiple to our target company. So now let's bring this back to ABC Technologies. So now assume ABC Technologies has an EBITDA of 1000 crore. This is the EBITDA for ABC Technologies. So if similar companies are trading at 12 times their EBITDA, then we apply the same multiple to ABC Technologies. So the valuation for this company, valuation becomes 12 into 1000 crore, which is 12,000 crore. Okay, so this means that based on comparable company analysis, ABC Technologies is valued at approximately 12,000 crores, right? Fair enough? Okay, now notice something important here. When we do all this, we did not make any prediction about the future, and we didn't make any aggressive assumptions also. We simply asked one question, and which was, how does the market value similar companies today? Now let's just pause and understand what this number actually tells us. So when we say ABC Technologies is worth 12,000 crore, we are not saying that this is the perfect or true value. What we are really saying is that this is how market would likely price ABC Technologies today based on how it prices similar companies. Now, a very important thing that we need to discuss right now is what CCA really reflects. So when we use comparable company analysis, what are we actually capturing? So firstly, CCA reflects current market sentiment. This means how investors are feeling about the sector right now. Like, are they optimistic about IT services? Do they believe growth will continue, or are they cautious because of global slowdown, there's AI disruption, or because of pricing pressure? So how are investors feeling about the sector right now? All of that gets reflected directly in stock prices and therefore in valuation multiples. Secondly, CCA reflects investor expectations. So when investors pay 12 times EBITDA for a company, they are basically saying, we believe this business can grow, stay profitable, and manage risk reasonably well. Right? They are saying that business can grow and can stay profitable and also manage risk reasonably well. So these multiples, they are not random numbers. Right? These multiples are not random numbers. They are market's collective expectation for the future. All right. And third, CCA reflects industry trends. What does that mean? So for example, if the IT sector is going through a strong demand cycle, then these multiples, they tend to expand. And on the other hand, if sector is under pressure, then multiples usually compress. So valuation through CCA automatically adjusts to what's happening in the industry at the moment. That's why CCA answers one very specific but very powerful question, which is, what does the market think this business is worth right now given today's conditions? Not what it should be worth in theory, not what it might be worth in 10 years. No, what the market is willing to pay today. That's very important. Okay, so now let's talk about why CCA is so powerful or so popular and why it is used so extensively in investment banking. So the first reason is very simple. It is used because it is based on real market prices. Right? It is based on real market prices. These are not assumptions sitting in an Excel sheet. These are real prices that real investors are paying with real money in the stock market. And this gives CCA a lot of credibility. especially when bankers are talking to clients. Right. And the second reason is that CCA is fast and practical. It's quick. So in real deal situations, bankers don't always have the luxury of time because deals move quickly. Clients want answers quickly. They don't have time to wait. They literally don't have any time to wait. So everything is happening so fast, and we need something which gives us a reliable valuation fast, right? Okay. And the third reason that CCA is so powerful is that CCA captures market mood or market sentiment, which is something pure financial models often miss, because it reflects optimism or fear amongst the investors, the sector cycles, the risk appetite of the market, and the macroeconomic conditions. And this matters a lot, people, because deals don't happen in a vacuum. They happen in real markets. That's why CCA is used across so many areas of finance. It is used while you are pricing an IPO, during merger and acquisition negotiations, for fairness opinions, and in equity research reports also CCA is used. In fact, let me tell you something. In real investment banking work, CCA is almost never skipped. And also it's usually the starting point. It is like the first reality check. So this is how important CCA is for you to understand, right? This is literally the starting point before bankers move on to more detailed valuation models. Okay, so now having said all of this, the book is also very clear about one thing, that comparable company analysis has limitations. It has its limitations. The first and most important limitation is that no two companies are exactly the same, right? So we cannot say that TCS is exactly the same as Infosys. Can we say that? No. So even if two companies operate in the same industry, their businesses can be very different. So they may differ in the quality of their management, the type of clients that they serve, their long-term strategies. They can have different long-term strategies, and also their overall risk profile can differ. So for example, one company might have stable long-term clients, while let's say that TCS has stable long-term clients, but at the same time Wipro depends on a few large contracts. So on paper they may look similar, but in reality the risk is very different, isn't that right? So CCA can't fully capture these subtle differences. And another important limitation is that markets are not always right. This is a very important statement. Markets are not always right. So stock prices don't just reflect fundamentals, they also reflect emotions. So markets are not only driven by fundamentals, they are also driven by emotions. Yes. So sometimes markets are overly optimistic and stocks become overpriced. And other times fear takes over and even the good companies become undervalued. So when we use market multiples, we are indirectly assuming that the market is pricing companies correctly, which is not always true. This means that CCA can sometimes carry market bias into the valuation. So which is a very big limitation, right? And then the third limitation is that CCA is mostly backward looking and present focused. What does that mean? So it means that it relies heavily on current financial performance and current market prices. And you may ask that what is the problem with that? The problem is that it doesn't fully capture future innovation or strategic changes. So for example, if a company is about to launch a new product, or they are planning to enter a new market, or completely change its business model, then CCA may completely miss that value. So a company that looks average today might actually have strong future potential. So for example, we have a third company here. Let's say it's XYZ. So today it looks average, but they may have strong future potential. Like they may be investing a lot in innovation, and they may have something which can become very valuable in the future. So CCA won't be able to reflect that properly. So it is another limitation of CCA. So the key takeaway here is that comparable company analysis is very useful, but it is not a complete valuation on its own. That's why in real investment banking work, bankers never rely on CCA alone. They always combine it with other methods like precedent transactions and discounted cash flow. So together these methods help arrive at a more balanced and realistic valuation. Okay, so now I'm going to end this video here today, and in the next video I will cover chapter 2, which is Precedent Transactions, where we value companies based on past M&A deals. Okay, past M&A deals. So if you want to learn investment banking in a structured, practical and beginner friendly way, make sure to subscribe and follow this series. And you can also comment down below if you have any questions. I'll see you in the next video. Till then, bye-bye.